Hello and welcome to Bloomberg Quint. You're watching the fine print. The insolvency ordinance that sought to keep promoters of insolvent assets out of the bidding process received Parliament nod this week, but with a little makeover. Remember, the ordinance was passed in November last year and had laid down a 10-point criteria that made several entities ineligible to submit resolution plans as part of the insolvency process. The criteria ranged from RBI, SEBI and Companies Act disqualification to inability to service debts. It is this criteria that has seen several important changes in the version passed by the Parliament. To understand what those changes are, the purpose and impact of them, I have with me Nilang Desai of AZB and Kumar Saurabh of Khaitan & Co. Gentlemen, welcome to the show. The first key change, Saurabh, has to do with who around a tainted resolution applicant becomes ineligible. Under the ordinance, the ineligibility of a resolution applicant extended to its promoter, person managing or controlling it, or any person acting jointly with it. The version passed by the Parliament has simplified this language. The ineligibility of a resolution applicant will now apply to any person acting jointly or in concert with such ineligible resolution applicant. What is the purpose of this change to your mind?
I think there are two key takeaways from the revisions that we see in the bill which got approved by the Parliament. There was, while this objective of keeping the promoters out of the bidding process for those who were NPA for more than 1 year was there in the objective, somewhere in the language that clarity was not there. And to that extent, the bill clarifies the position that if a promoter, along with the corporate debtor, is in default for more than a year, then the promoter is also disqualified if the payment of the overdues is not made. So it's not only the corporate debtor, but also the promoter who is disqualified. Linked to that, there is also clarification on the point that resolution applicant who can apply. The resolution applicant, along with anyone who is in management or control of the resolution applicant, or jointly acting with the resolution applicant, or acting in concert with the resolution applicant, should not be a person disqualified. So I would say the acting in concert concept has to some extent clarified the position, but has also expanded the scope, because you have your public market SEBI regime which defines acting in concert, and that is, I would say, much wider.
Sure. No, I'll come to how do you interpret this person's acting in concert, but my limited point is what sort of situations got left out from the ordinance language that this Parliament had to sort of, change that language and make it slightly more broader?
I would say the point around promoter being disqualified, while that was there in the objective behind which the ordinance was introduced, but if somewhere in the language it was not very clear whether the disqualification only affected the corporate debtor or it also affected the promoter of the corporate debtor.
But it did, right? The ordinance language said that the ineligibility of a resolution applicant, it extended to promoter, person managing or controlling it, or any other person.
No, but it referred to promoter or person in management or control of the resolution applicant or of the corporate debtor post-resolution. So what happens to the period prior to insolvency commencement? There is a promoter who is there prior to insolvency commencement. He was probably not getting well covered, and I think this iteration of the draft take care of that doubt which was there. It amply clarifies in 29AC now to cover even promoters.
Okay. Nilang, let me come to you. I'm keen to understand, what sort of structures were possible based on the ordinance language that are now rendered impermissible because of this change in language.
So I think the lead-in language of 29A had earlier in the ordinance said extended it to promoter, persons managing or controlling it, and that's come out. I don't think that's a significant change because the definition of connected persons already has that. So I think that was a reiteration which was taken out. But the acting in concert was, I think, a significant change, is a significant change. It, as Saurabh says, it significantly widens the language. The immediate reference most lawyers would make would be under the takeover regulations, where it's defined, and there have been several years of jurisprudence in trying to understand what that term means. And we certainly think it's wider than acting jointly. I think when the ordinance came out, the leading language of 29A allowed for some structures to operate on the fringes of that definition. A combination of trust structures, minority holdings, call options, structures offshore, etc. And I think maybe the intention of the government here with this much wider remit of acting in concert was to bring in the legislation the spirit of what they're trying to achieve. And persons acting in concert with its wide remit might actually catch the spirit better than acting jointly only.
Okay, so Saurabh, are you clear that what will this persons acting in concert, what all will this include? And are there still structures which are possible, which may be able to use this language and yet be connected to the resolution applicant in some fashion?
So what is covered in acting in concert is really a question of interpretation. The code doesn't define what is meant by acting in concert, nor does Companies Act define, because code takes you back to Companies Act. So both these legislations don't define what is acting in concert, but you have a public market regime where this is very well understood and interpreted by courts. And I think with the objective of the code, that's a definition that one will have to look at and will be relied upon quite a lot. In the context of that definition, which goes to objective or purpose of acquisition of shares with which one or more persons come together through a formal or an informal agreement, I think that is quite wide to limit scope for structuring, and remains to be seen what will go through because that really is in the realm of speculation at this stage, and how the NCLT and the courts would look at such structures. But a short point would be that today that concept has been expanded, and the room for maneuvering, I think, has been consciously curtailed. So it may take away room from structuring which was possible perhaps.
So Nilang mentioned certain trust structures with minority rights. Were there any others that people were toying with based on the ordinance language that are now rendered impermissible?
Look, I would put it this way. What is possible under the law is what was being tried, whether it is a combination of trust or any investment structure. It was all being contemplated within what is permitted under the law.
Letter of the law, not necessarily the spirit, maybe.
Not necessarily the spirit is a point of, again, interpretation. But with this whole change in regime which has come about, I think some of that may also get covered under restriction. So it may become a lot more difficult to look at structuring to come out of the restrictions. But again, some of this is new and will be interpreted. So can you extend this whole restriction to minority arrangements, or someone who is providing only services, or in an arrangement which is very informal but is integral to business? Those are things which will have to be seen, but some of the business requirements may trigger necessities which law will have to cater to. So even in the interest of resolution, you may have to allow certain arrangements to go through, and the law will have to cater to such requirements. So it remains to be seen, but obviously the scope of the restriction has been made wider without doubt.
Okay, so that ineligibility criteria has seen expansion, if I can call it that. The second change seems to have brought some relief for guarantors, Saurabh. The ordinance had made any person ineligible to be a resolution applicant if such person had executed an enforceable guarantee in favor of a creditor for a company facing insolvency proceedings. The bill changes the language to say that this ineligibility criteria will apply only if the creditor who had received this guarantee initiates the insolvency process. Do you see this as the narrowing of the ineligibility criteria for guarantors? And again, weigh in on what is the purpose of this?
I would say this brings in consistency of approach. if you have given a guarantee which has not been invoked, is there a reason to disallow such a person? The only possible argument of disqualifying a bidder in that situation could be that if the same creditor has gone to NCLT, why would he have gone? Because the guarantor could not have paid, and therefore for insolvencies which are initiated by beneficiaries of guarantees, you cannot allow bidders who have also been guarantors. But I think this is again not going to change the regime in a very big way. On the face of it, it may look like it's a relaxation relief, but you would see in consortium arrangements mostly all the lenders would have benefit of guarantees.
Right.
So it would not be a case that 1 out of 10 has benefit of guarantee. So on possibility of any one of say 10 lenders going to insolvency and courts, you would see that that lender has benefit of the guarantee. So in effect, you would still be disqualified from bidding if this condition is there. It's debatable whether you should allow disqualification, but we have gone through this process of debate and we have settled to a position where we want to put thresholds which are much stringent than what is there in some of the other jurisdictions. And I think this revision may not actually extend any really big benefit to people who are otherwise disqualified.
Okay, Nilang, do you also agree with Saurabh's view that this is not exactly a big relief?
For the most part, I mean, a plain reading of it certainly looks like a significant change to the position in the ordinance. Having said that, as Saurabh said, I think in many cases these guarantees will extend to a very large number of the banks in the consortium or in the ring of lenders, which means that inevitably this relaxation or perceived relaxation in the language will not really benefit such borrowers or such guarantors. Having said that, maybe there's a slight distinction to be made, which is that companies which have become more recently stressed will inevitably have a situation where the promoter has given its guarantee to much fewer lenders, as opposed to borrowers who've been stressed for a long time, where there have been a series of restructurings and reborrowings and new lenders coming in, etc. In those cases, as Saurabh says, I think it's likely that the promoter guarantee will have over time extended to almost all the lenders. So again, just to summarize, I think the more recently stressed borrowers may benefit from this relaxation, the long stressed borrowers may not.
Okay, and Saurabh, you're saying something.
I would think that the only positive change which can result on account of this whole condition of ineligibility is that you may see financing with less guarantees going forward. So even if you don't see this as a big relief for existing cases, going forward there may be more negotiations around guarantees, because you know that that makes you completely ineligible to participate in the process, even if the problem in the debtor is for factors which are outside your control. So if the project is not complete, because of which you are not able to service your debt in time, merely because you have given a guarantee, you are disqualified. If the account is not NPA for a year, only because you have given a guarantee, you are disqualified. So that's a factor which will now play in these credit decisions, and from borrower side they would also...
And also because individual insolvency regulations are also in place, so that will also deter people from giving these guarantees, right?
Absolutely. So that's another aspect which will obviously now going forward have a bearing on some of these financing transactions.
Sure. Nilang, were there any court decisions on this aspect that also come into play here?
I was going to say, yeah, actually, I think the Kolkata bench of the NCLT, in a decision towards the end of last year, held that just simply having a guarantee in place from a promoter doesn't render him ineligible. And the view they took was that guarantee must have been invoked and remained unpaid. And I think that's a sensible decision, as Saurabh mentions, that it's a bit harsh to say just because you've given a guarantee, even if not invoked, it should make you or render you ineligible. So read with that judgment, I think that the impact of this ineligibility or disqualification has been reduced in practice.
So the changed language is in line with what the Kolkata NCLT has held. Okay, gentlemen, the final change I want to talk about seems to be a breather for AIFs, scheduled banks and asset reconstruction companies. The ordinance had barred any person who had an ineligible connected person from submitting a resolution plan, and connected persons included any person who is the promoter or in management or control of the resolution applicant, any person who shall be the promoter or in management or control of the corporate debtor during the implementation of the resolution plan, and third, the holding company, subsidiary company, associate company or related party of persons mentioned in the first and second category. So, Saurabh, the bill has exempted the AIFs, scheduled banks and asset reconstruction companies from the application of this clause 3 in the definition of connected persons. What difficulties is this change meant to address?
So this was again a case of unintended consequence of the ordinance. So under the ordinance, you covered anyone who was in promoter position or in management or control of a resolution applicant or of a corporate debtor who is otherwise having any problem in any of his existing investments. I think by excluding AIFs, banks and financial institutions, you are recognizing the fact that these are not categories of investors or lenders who are generally in the business of running businesses, and if you are except for financing or investments that they have made, and therefore there is a case to look at them differently and allow them to continue to participate in a bidding process. So if a bank, because of conversion of debt into equity, or a AIF because of the investments that it may have made, but which were all in the nature of financial investment, they were not promoters. If they are in a situation where there is a NPA, you should not disqualify them simply because of the fact that the debtor is disqualified or the promoter of the debtor is disqualified. So this in some ways takes away that limitation as far as the banks and the AIFs are concerned. And to that extent, it is just clearing a position which was an unintended consequence of the ordinance. And the ordinance also in effect never intended to cover these classes of institutions. Okay,
Nilang, is that how you're reading it as well in interpreting this exemption?
Yeah, more or less. So, I mean, if you take a step back and look at the theme of 29A, what it's trying to do is it's trying to exclude from the process people who have done, for want of a better word, inappropriate things. And the idea of excluding AIFs, ARCs, and scheduled banks, unfortunately not financial institutions, I think has been to recognize the fact that these kind of entities will have holdings, investments, interests in other entities which may be stressed and may have at some point of time done some of these inappropriate things, but these entities would not have or are unlikely to have played an active part in that act happening. So despite their connection to such tainted entities, it doesn't make sense to keep them out of the bidding process. So it's simply a recognition of a sensible commercial fact, as Saurabh points out.
Having said that, I would still think that exemption could have been made. The exemption could have been more wider than the disqualification. It could have been exempting these classes of institutions from applicability of the entire section. It only excludes applicability of the explanation on connected person, and I think that is still limiting. So it could have been done in a slightly different way, but that's where we are currently.
Well, who knows, there we may see another round of amendment to widen this exemption. Saurabh, Nilang, we're completely out of time on this discussion. Thank you for joining us on the Fine Print today. Moving on, you're welcome to stay, but we won't let you go. That's what the insurance regulator is telling foreign private equity funds looking to invest in Indian insurance companies. Recently, the IRDAI allowed entry of foreign private equity funds as promoters in Indian insurance companies. But experts tell Ridhima Saxena that the rules are in conflict with existing laws and will make for a difficult exit.
Until as recently as last month, private equity funds could only purchase up to 10% of the equity of an Indian insurance company. The cumulative limit for all private equity investments in an insurance company was 25%. But in December, the insurance regulator, the IRDAI, permitted private equity funds to own more than 10% and even control the company as promoter.
While the IRDA has viewed PE capital as the most unstable form of capital, in fact calling them as capital that is looking for capital appreciation and quick exit, the factum that there were several applications that have been received and the market realities left IRDA with no option but to come out with set form of guidelines to allow PE funds to take up strategic positions and majority positions in insurance companies.
It's a road, but with a lot of potholes right now. The guidelines were meant to provide a regulatory framework for private equity funds to invest in insurance companies, but it has opened up many questions.
The questions Shah is referring to emanate from a rider that come with the IRDAI's recent guidelines. Private equity funds can now become promoters, but they must take their investment through a special purpose vehicle or an SPV, which will then invest in the Indian insurance company. The IRDAI has stated that the SPV can either be a limited liability partnership, an LLP, or a company, but both come with their own set of problems. The LLP structure would conflict with the existing laws. The Foreign Direct Investment Policy states that an LLP created for the purpose of investment will need prior government approval for any foreign investment to come in.
If we assume for a minute that the PE guidelines do apply to foreign PE funds and they are to go through the SPV structure of an LLP, they would have to take additional approvals to first infuse capital into the LLP under the foreign exchange laws, and therefore they would not be able to avail of the automatic route of FDI in the insurance sector by just getting the IRDA approval. So it would be a deterrent and it would mean an additional layer of approvals.
The other option is to design the SPV as a company. But in this case, every time the SPV pays a dividend to the promoter private equity fund, there will be a 20% dividend distribution tax levied.
It is true that in certain cases, under the SPV route, there could be a tax inefficiency on account of dividend distribution. First, it would be at the level of the insurer distributing it to the SPV and then the SPV distributing it to the PE fund. Having said that, in my view, for the insurance sector, this is unlikely to happen, given the long gestation period that they require to break even and then turn profitable. And in all likelihood, PE investors at that stage are going to be looking to exit the venture through IPO or strategic sales.
Experts say that the special purpose vehicle requirement would not just pose challenges on the structuring front, but will also make the exit of private equity funds cumbersome. Firstly, in the form of a higher tax bill, and secondly, due to a lengthy lock-in period.
A PE investor will be able to get an exit either through an initial public offer or a stake sale. In the case of an IPO and subsequent listing, the PE investor is likely to face double taxation. That's because when the PE fund sells its stake in the insurer through public listing, the sale amount will first accrue to the SPV. As this amount will be considered income generated by the investment vehicle, it will be liable to pay a minimum alternate tax of 20% on its profits. After paying MAT, the leftover proceeds will have to be transferred by the SPV to the PE fund, and that transaction will be subject to either a dividend distribution tax or a buyback tax. Together, the MAT and dividend buyback tax add up to 35%. So far, PE funds have had a cheaper exit through the IPO route, as only a 0.1% of securities transaction tax was payable.
So despite the PE funds investing as a long-term player, because there are those lock-in periods requirements, they will have been paying a tax as if it was a short-term capital gains tax. So I think that's the big this thing from their perspective on their rate of return and their effective yield from this investment. The issue therefore is this regulations making any change to the current scenario? To my mind, no, because it will be extremely difficult for private equity to invest through the investment company or the special purpose vehicle due to the high tax incidence.
The other option for an exit could be a stake sale, but in this case, a 10% capital gains tax will apply on the foreign PE fund. Experts say this too is not a favorable situation.
Alternatively, somebody can always sell the special purpose vehicle. If one were able to do that, and it's not that easy, it's very challenging, then there would be a 10% tax because the special purpose vehicle will be an unlisted company forever. So I think there is a possibility, but the issue then is the entire burden tomorrow passes on to the new buyer, and he's going to discount it in the value.
The exit problem is not just plagued by higher tax implications. Lock-in requirements will prove to be a challenge too. The private equity investor will trip on different SEBI and IRDAI regulations regarding promoter lock-in. IRDAI has mandated a lock-in period of 5 years for promoter PE funds from the date of investment. But SEBI's lock-in requirements kick in from the date of listing. It's a 3-year lock-in period for promoters with 20% shareholding and 1 year for promoters with above 20% shareholding.
This clash or this dichotomy between IRDA laws and SEBI laws need to be resolved and needs to be resolved soon, because if you want to invite private equity investment in the insurance space, you cannot have this disconnect. If there is a private equity fund which is recognized as a promoter by IRDA, which has already suffered a lock-in of 5 years, you cannot expect him, the same private equity fund, to suffer additional lock-in only because SEBI requirements mandate an additional lock-in. So these laws need to be rectified.
These are only few of the many challenges that come with the IRDAI's recent guidelines. Experts say that instead of complicating their lives with the structuring and the exit issues, private equity funds may choose to be pure investors than promoters in the Indian insurance companies.
Well, looks like the guidelines will have to be tweaked to attract any private equity investment in the insurance sector in the capacity of a promoter. That's all that we have on today's show. Thanks so much for watching. We'll see you next week.